Meanwhile, new data out today from the S&P's Case-Shiller Home Price Index showing U.S. home prices hit an all-time high in March. The measure of home prices across the country showed that all of the major metro markets reported a month-over-month price increase and a 6.5% year-over-year increase. Joining us now to discuss is Redfin Senior economist Chen Zhao. Chen, welcome. So long term, it seems to me, there's a danger for consumers stretching too much into housing. I mean, prices don't have to dip much to hurt you if you need to move or if you lose your job and you can't sell the house for what you bought it for. When's the last time we saw this kind of unaffordable environment?
Hi there. Thanks so much for having me today. Yes, absolutely. Unaffordability is really the story in the housing market right now, as the Case-Shiller data today showed. And one thing to keep in mind, though, about the Case-Shiller data is that it is somewhat backward-looking. So this data is for the 3-month period that ends in March. Redfin has our Redfin Home Price Index, which last week we released data for April. And that showed that home prices were up 7.3% year over year, which was very similar to what we saw in our data in March as well, meaning that there's really doesn't seem like there's much relief on the horizon in terms of home price growth. So I think for the average consumer, what that really means is, as long as inventory is very constrained, which it has been for the last couple of years or so, home prices really do seem like they will continue to appreciate at a fast rate.
Okay. So what do you see happening geographically that investors should know about?
Absolutely. So there is a good deal of variation from market to market. Where you're seeing the most weakness right now is in the Sun Belt, where there has been a lot of construction over the last couple of years since the pandemic. There you're seeing the most supply. So that is leading to softer home price appreciation in some cases, like in Texas and Florida, you're seeing pockets of price declines as well. But in other markets like the Northeast, where you have less new construction, their prices still continue to appreciate at a pretty fast clip.
How does all of this translate to rental prices? And we know renters and shelter prices are an outsized portion of the CPI. They do funnel to a certain extent into PCE, which we get later this week as well. What are you seeing in real time across these different markets, whether it is the Sun Belt, as we start to see prices ease on the home purchasing side, or in some of these more expensive areas like the Northeast?
Absolutely. So for the rental market, what we see in our real-time market rent data is that rent prices are very flat. So our latest measure is they're up about 1.1% year over year. That is very similar to what we've seen for like the last 18 months or so. The geographic variation is somewhat similar to what you see in the housing market. So you do see the most weakness in markets that are in the Sun Belt, where you did have a lot more multifamily construction, and you also have a lot more supply that is yet to come to the market. But that, like you said, has really yet to kind of filter through to the official inflation statistics. That lag seems to have been longer than anyone really anticipated. And there, it seems to be a story that's really about renewing leases versus, people who are renewing their lease and not moving versus those who are a new tenant moving into a new apartment. When someone renews, that rent tends to go up a little bit less, so it takes a lot longer for them to catch up to the market rent. And that seems to indicate that it's going to be a while yet before we really see the market rent data fully flow through to whether it's CPI or PCE.
Which, of course, raises the questions about when the Fed cuts, why the Fed cuts, and if in the meantime, whether home buyers, especially since we are in this busy spring home selling season, are now getting more comfortable with the idea of these higher mortgage rates.
Yeah, I think for the Fed, the consensus expectation right now is really that the Fed will hopefully be able to cut by September. I think that there is some chance, that the inflation data that is coming out in mid-June or mid-July could be a little bit better than expected, in which case July is back on the table. And July has the advantage of being a little bit farther away from the election in November. But if you're a home buyer, I don't know that this kind of like July versus September calculus is really what you need to be, like totally wrapped up in right now. I think what you need to know is that probably we should expect a little bit of rate relief going into the second half of the year. But for a typical home buyer, what's really much more important is kind of long-term considerations. If you're looking to stay in your home for more than 5 years, you will most likely see home price appreciation. When rates come down, you can refinance. It's much more important to consider your own personal circumstances and whether you can find a home that you can afford that is appropriate for your family than to worry about whether the Fed is going to cut in July versus September.
Okay.